Okay, may I request you to put yourself on mute? Okay, now we were talking about, okay, thank you, right? So we were talking about subsidies. What are subsidies? Subsidies are financial payments that government give to producers, right? Now, when subsidies are provided, what happens? Your supply curve shifts to the right, right? So you have price on the y-axis and you have quantity of the good on the x-axis. You have quantity of that good on the x-axis, right? So let's be more specific here. Quantity of vaccination. Why would government want to give subsidy on a product like this? Because it's a merit good. It's a merit good, opposite of that. Now, what's the definition of merit good? Merit good is a good that is beneficial for consumers, but they do not fully realize the benefit, therefore they underconsume, right? Something that is beneficial for consumers, right? Think about it. Vaccination is an ideal example, right? And that is for consumers, but they do not fully do not fully realize the benefit, therefore they underconsume, right? Because obviously when you're not fully realizing how much beneficial something is, then you will always underconsume. Okay, now this being said, students will move on and we'll look at the graph for the minute growth. Okay, now first things first, as I said, all you have to do is to draw a downward sloping demand curve like this and an upward sloping supply curve, right? Now, where the supply and demand are equal for a product, that is its original equilibrium, right? Now, the two are intersecting at this point. So let's say before government subsidies, each vaccination was selling for, let's say, 8,000 rupees, right? So let's say 8K, right? Per vaccination of COVID or whatever vaccination it is, right? And the total quantity that was produced and sold in the market was, let's say, 10 million vaccination per month, let's say, right? Okay. Now, this being said, what happens? I did tell you that what are subsidies? Subsidies are financial payments made by the government to producers. Subsidies are financial payments made by the government to producers. Okay. When that happens, your supply curve shifts to the right. Your supply curve shifts to the right like this, right? Because cost of production is reducing. With that happening, what happens? Your cost of production decreases, your supply curve shifts to the right because now it will be more profitable to produce the good, yes or no, right? Because for the same quantity, right? Now some expense, because what is profit? Think about this. So profit is revenue minus cost, right? So if let's say your vaccination is selling for the same price. Obviously, it will not after the subsidy, right? But I mean, think about this. But government is also giving you some additional amount, right? So we can think of that to be adding to your revenue. Students, are you getting me? So when subsidies are provided, these are financial payments. So whatever the price the producers are getting from the sale of vaccination, that is not all. Producers are also getting additional amount in the form of subsidy from the government. So when you add these two up, right, and your cost, let's say, stays like this, or you can think about it that your subsidy is contributing to the cost. I mean, it's just the way you want to look at it. But overall, eventually, there will be more money into producers' pocket, which will help them earn more profit. So it's incentive for them to produce more. And therefore, your supply curve will shift to the right. Are you getting me? Right? Okay. Now, with this happening, your supply curve will shift to the right in case of subsidies, which is opposite of what used to happen in the case of indirect taxes. Now, the new equilibrium point will be where the new supply intersects with your demand curve. So this is the new equilibrium point. So you connect it to the y-axis, and now here's the main thing. Now, this is PC. What is this? Where the new supply curves intersects with the demand curve, which is the new equilibrium, that will show you PC. PC meaning the price that consumers will pay. Now, why are consumers paying a lower price? Think about this. Just like the burden of indirect tax is split between consumers and producers, similarly, the benefit of subsidies also shared between consumers and producers. I repeat, just like the burden of indirect tax is shared between consumers and producers, the benefit of subsidy is also shared between consumers and producers. Now, how would consumers PC, the price, I mean, just in notation that I used to tell you that the price that consumers are paying now, right? Just like in the previous example, you saw that in the case of indirect tax, PC was the price that consumers were paying. In this case, PC is the price that consumers are paying, right? Now think about it. If previously vaccination was 8,000 rupees before subsidies, now with, and government has, let's also take a specific example. So let's say government has given a subsidy of 1,500 rupees per unit, or sorry, per unit, per vaccination, whatever you want to think it, right? Think about it, right? So 1,500 rupees of subsidy per unit. Now, let's say, the price that consumers are paying is 7,500 rupees. The price that consumers are paying is 7,500 rupees, right? Now, what you have to do, the method stays the same. The method that you were using in indirect taxes will be the same as you will use in subsidies. Now think about this. You take this line, dotted line from your new equilibrium point up to your old supply curve. I repeat, you take this dotted line up, right, from your new equilibrium up to your old supply curve, which is this, and then you connect it to the y-axis, and this is the price that producers are receiving. This is the price that PP, producers, will receive. Because think about this. Consumers come and pay 7,500 rupees for each vaccination, but that's not all. That's not all. Why is that not all? Because 1,500 would also come to them from whom? From the government. So did you get this or not? I know this could be a little tricky. That's why I'm taking time to explain it slowly, right? Now, think about this. Right, sure. This was the price. This was the price, right? Let's look at this one more time. You have to stay with me, right? Now, sorry about that, right? Okay. Now, downward sloping was the demand. Upward sloping is the supply, right? Where the two intersect, that is the original equilibrium, right? Now, before any subsidy, each vaccination was selling for, let's say, 8,000 rupees. 8,000 rupees consumers used to pay for each vaccination, and 8,000 rupees used to go into producer's pocket. Simple, nothing complicated. Yes or no, right? So this was the equilibrium price. How much quantity was being bought and sold in the market, right? Let's say, I don't know, 10 million, let's say, right? Okay. Now what happens when government provides subsidies, that reduces your cost of production, because that is a financial payment coming to producers. Now what is subsidy? Financial payment that the government makes to producers. Because think about this, it's technically not possible for the government to come to each individual house and pay them the money. And again, they don't know if the money would be used on the vaccination or not. So the way subsidies operate, that government gives the subsidy amount directly to the producers. Government gives the subsidy amount directly to the producers. But again, do remember that if government is giving a subsidy of 1,500 rupees per unit, then not all of this amount would go into producers' pocket, right? So some of this amount would also benefit consumers in terms of lower prices. Students, are you getting? So just like for indirect taxes, when government imposed 20 rupees indirect tax on each packet of cigarettes, so the burden got split between consumers and producers. How? Because there was increase in price, but not by 20 rupees. So the price increased from 100 to 110. So which means that consumers then started paying slightly higher than what they used to pay, right? And 10 rupees was the burden that producers faced, because previously they used to get 100 in their pocket. Now they were getting 90 in their pocket. So there's a loss of 10 rupees per unit. Easy. So that was indirect tax. Now with the case of subsidy, what happens that if government provides a subsidy of 1,500 rupees, the cash would directly be provided to the producers. The cash the amount, the financial cash, right, will directly be provided to producers who are producing vaccination, that vaccination in Pakistan or in any other country. But it will not all go, not all of this 1500 would go into producers' pocket. It will be split. What do I mean when I say it will be split? Some of this goes into producers' pocket and some of that will benefit consumers in terms of lower prices, right? So basically, subsidies cause the production cost to be lower, causing the price to fall, benefiting consumers. Exactly. Yeah, that's the idea. So when subsidies are provided, that increases supply. When supply is increased, obviously we know the new equilibrium price will be lower, which we are about to see next. And therefore, consumers benefit in terms of lower prices. Any confusion, students? Please ask me if there's any confusion, right? Now, when subsidies are provided, the supply curve will shift to the right, as we know, right? And when that happens, where would be the new equilibrium? The new equilibrium where we would be where the new supply and the demand curve intersect, right? So this is the new equilibrium point. This is the new equilibrium point, right? Now, what you need to do, you will connect it to the y-axis and you label it as PC. PC meaning the price that consumers will pay. Now, instead of 8,000, let's say now each vaccination is costing 7,500 rupees to consumers. Now, this was your old equilibrium. Now, this is your new equilibrium. Now, what you need to do next, students, is this clear so far? Right? Now, what you need to do is to take this point from the new equilibrium old to the back to the old supply curve or the original supply curve, right? Right? This is the original supply curve. Then you connect this point to the y-axis to see that how much is the price that producers will receive. Now, instead of me telling you, can you guess how much is the price that producers will get? With all this information provided to you, can you guys guess how much is the price that producers will receive? 7,500 is being paid by consumers and 1,500 rupees is coming from the producers. So how much will actually go to producers' pocket? How much will actually go to producers' pocket? 9,000, right? Students, consumers come to the clinic, pay 7,500 rupees for the vaccination, and then for each vaccination that is being produced by the producers, government also pays them 1,500. So 7,500 plus 1,500 gets you 7,500 plus 1,500 gets you 9,000. Yes or no? Right? 9,000, right? So that is what goes into producer's pocket. Right? Easy. We good on this? Any confusion so far? Is it making sense? Right? Now, the same analysis that we did for indirect taxes, we'll do the same analysis for subsidies and see that in the case of subsidy, both consumer and producer surplus will increase. We'll do the same analysis that we did for indirect taxes, and we'll see that in the case of subsidy, both consumer and producer surplus will increase, but we'll not do that today. We'll do it tomorrow. But for now, just remember the shape of the graph, just see what has happened. If there's still any confusion tomorrow, I'll be happy to answer those, answer your questions. And then we'll look at how subsidy is increasing both consumer and producer surplus. We good? Students, is everything clear? Right? So let's stop it for today. I'll see you tomorrow. Take care and have a good night. Allah Hafiz. And I'll explain you about the internship over the, okay, he's already left. Bye.